For the founder of an SME, generating revenue is the first equation. The harder calculation is transitioning that wealth into their personal hands. Corporate capital is legally distinct from personal capital. Moving money across that boundary is never neutral. It always triggers a tax event. Most founders rely on naive extraction, pulling capital out of the business through standard corporate dividends. This flowchart maps the penalty. Out of the gross profit pool, 20% is immediately siphoned off to cover baseline corporate tax. The remaining 80% moves forward, but another 10% is taken as personal withholding tax. The standard dividend route results in an aggregate tax drag of 28%, steadily eroding the founder's net wealth. The optimized alternative requires reclassifying wealth extraction. Instead of taking a post-tax distribution like a dividend, the extraction is structured as a pre-tax corporate expense. This method operates through formalized, legally structured director welfare. The primary mechanism here is the tax gross-up. A tax gross-up is a legal arrangement where the company pays the personal income tax on behalf of the director. This is a rigorous architecture, fully compliant with the Revenue Department, the central tax authority in Thailand. Executed properly, it drastically reduces the aggregate tax burden. Let's run a mathematical case study to isolate the exact cost of an inefficient tax architecture. This ledger shows scenario A, establishing our baseline. We have a corporation generating 22 million baht in gross profit. Applying standard parameters, a 20% corporate tax rate multiplies against the profit. The calculation yields the final baseline liability, 4,400,000 baht in corporate tax. Absorbing a 4.4 million baht loss is the inevitable mathematical reality of operating without a specialized extraction strategy. Now, we apply the director welfare strategy to the exact same 22 million baht company. This side-by-side visualization tracks the capital flow. We insert the optimization step. An executive welfare package is applied before the corporate tax calculation. Recognized as a legitimate business expense, it legally reduces the taxable profit base. The aggregate tax burden drops to 2,520,000 baht. Look closely at the mechanics inside that 2.7 million baht welfare package. The founder extracts 2 million baht in cash using the tax gross-up. This pie chart isolates that specific 2 million baht extraction. The mathematics prove the effective tax cost of this maneuver is precisely 8%. When the company absorbs the personal income tax on the director's behalf, corporate tax savings offset the expense. The net cost is highly efficient. Structured welfare operates as a precise financial instrument. In this single fiscal year, the architecture preserved nearly 2 million baht. The Revenue Department will immediately disqualify these deductions if specific corporate governance rules are ignored. First, the welfare must be formalized. It requires official board resolutions and must be documented step by step in the company's accounting manuals. Second, the policy relies on absolute non-discrimination. If a managing director receives a specific welfare tier, all directors holding that exact rank must receive equal treatment. You cannot selectively distribute the benefits. One highly effective, legally recognized instrument for facilitating this welfare is Keyman Insurance. Keyman Insurance is a corporate policy covering the life or health of a crucial executive, where the company pays the premiums and treats them as a deductible expense. Certain Keyman policies are uniquely structured. They allow strategic, mid-term capital withdrawals without triggering additional personal income tax liabilities for the executive. Meticulous legal documentation unlocks the massive tax advantages demonstrated on the ledger. Without it, the entire architectural strategy completely collapses. The most common alternative SME founders use to avoid taxes is the informal director loan. This balance sheet grid tracks what happens when you take company cash without formal declaration. It instantly creates a toxic anomaly. This loan is an unerasable phantom asset. It cannot simply be ignored, and it cannot be deleted. An outstanding director loan carries fatal consequences. Legally, it prevents the dissolution or closing of the corporate entity. If a founder attempts to dissolve the company, the Revenue Department will aggressively force them to add the bad debt back into the taxable revenue pool. Furthermore, this toxic asset actively repels investors. It blocks M&A transactions, buyouts, and IPOs until it is cleared with real cash. Using a director loan as a liquidity hack ultimately destroys the founder's ability to ever sell or exit their own business. Historical methods of hiding director loans no longer work against modern enforcement realities. The Revenue Department operates a fully integrated system capable of auditing financial history retroactively for up to 10 years. The RD bypasses the company's own books entirely. They pull third-party data directly from banks and corporate payers to build their own models. Their operational algorithm is highly pragmatic. They prioritize and target individuals and companies that are mathematically easy and worthwhile to audit. Massive unresolved director loans act as a beacon. They flag a company to the algorithm as an easy target for investigation. Attempting to outsmart a 10-year automated data network carries financial and psychological costs far exceeding the price of structural compliance. A final hurdle is on the horizon: the imminent rollout of mandatory, pre-filled e-filing systems. The era of manually entering tax data is ending. Soon, founders will merely be asked to verify or dispute data the government already possesses. E-filing data can be disputed, but a successful dispute requires flawless, formal documentary evidence. A founder faces 3 mathematical choices: accept a 28% wealth destruction via dividends, paralyze the company with illegal director loans, or implement formal executive welfare. Structuring wealth extraction correctly drops a 4.4 million baht tax bill down to 2.52 million baht. In an era of automated, data-rich enforcement, rigorous structural optimization is the only mathematical guarantee for retaining corporate wealth.